I am Shanna Kaminski. I'm an attorney at Varnum. I specialize in litigation, both commercial litigation and bankruptcy-related litigation, bankruptcy and restructuring, and creditors' rights. Before I get into introducing our esteemed panelists, I do want to thank John Clem of Spectrum Commercial Services. Honestly, this program today would not have happened without him. From assembling who the panelists were going to be to developing what the content of the program was going to be, including questions, it all wouldn't have happened without him. So we want to thank him for everything that he has done for this program. The Detroit TMA chapter is lucky in that it has an awful lot of sponsors, and we just want to recognize them as well today. The gold sponsors for the chapter are Alderney Advisors, Dickinson Bright, Crestmark Bank, First Business Capital. The silver sponsors are Advanced Manufacturing Group, Alex Partners, Amherst Partners, Conway McKenzie, DWH, EDSI, Jaffe Wright Bjorn Weiss, Kerr Russell Weber, M-Bank Business Credit, McDonald Hopkins, Miller Canfield, Plant Moran, Plunkett Cooney, and Varnum. Our brown sponsors are Harmon Partners, Great Lakes Business Credit, Hilco Global, O'Keefe, and O'Keefe actually supported this webinar. It wouldn't be happening without O'Keefe either. Oxford Bank, Schaefer and Weiner, and the Dragich Law Firm. So we're planning for a structured discussion today, but we are interested in your questions. So please, if you have any questions as this is going on, put them in the chat. We will get to them when we are able, and to the extent that we cannot get to them, we will make sure that they are given to the panelists, and the panelists will email you and provide you with the answers to the questions that you have. So we have 4 great panelists today. The first person that you'll be hearing from is Robert Bowles. He's the founder and executive director of Bluewater Transaction Advisors. Bluewater Transactions Advisors is a field examination firm headquartered in Michigan with staff spread across the United States, servicing a large segment of national, regional, and local lenders. He specializes in helping guide secure lenders in assessing their collateral and associated risks. He has overseen numerous forensic accounting examinations and has been retained by counsel for his fraud investigation expertise. His efforts have directly led to the recovery of millions of dollars in misappropriated assets. The second person that you'll be hearing from today is Tim Anderson. He is an executive vice president of Hilco Valuation Services. Tim joined Hilco Valuation Services in 2001. He has conducted and managed thousands of appraisals on behalf of lending institutions worldwide. These valuations are comprised of retail, wholesale, and industrial operations in most key markets. Tim's tenure at Hilco provides a diversified background to assist these institutions in recognizing collateral value and potential exit strategies for their portfolio companies. Tim currently oversees consumer and retail appraisal operations. Our third panelist is Andy Dahlman. He is also an executive vice president at Hilco, but for Hilco Global's industrial and equipment valuation practice. Andy has been in the equipment valuation and liquidation industry for over 25 years and part of the Hilco team for over 20. And our last person that we'll be hearing from today is Jared Friedman. He is the Director of Opportunities for Friedman Real Estate. Jared currently runs the Capital Markets and Institutional Advisory Group at Friedman, specializing in selling, advising, and turning around distressed assets. Prior to Friedman, Jared worked in the private equity space for firms, including Equity Office Priorities and Origin Investments. Now, if you think I could remember all of that, you're crazy, because I couldn't. So we'll get right into it then and talk to Robert a little bit. Now, Robert, you sort of specialize in auditing and making sure that the collateral is there, correct?
Correct. Yep.
So what trends are you seeing in AR collateral and inventory collateral?
Well, the trends that we're seeing on the AR side is that companies, borrowers of the banks, are their AR is being extended in some instances beyond what their formula availability period is. So a company that may have 0 to 90-day availability on borrowings now may have a much larger chunk of their AR past the 90-day mark, and they're having to go back to their bank and discuss how to handle those. That also causes issues with other ineligibles and the calculations and how we do them. So we're getting feedback from banks on how they want us to handle some of the additional calculations with specifically to some customers that might be on the borrower's aging. With inventory, there's like a void of potential sales transactions for 2 to 3 months. And we are trying to have to figure out how we're going to calculate excess inventory over what period of time. Do we do it before COVID-19? Do we include that period of time? And each one of these situations is unique, and that discussion is going on with the bank and the borrower at the same time to make sure that we're giving a real clear picture of where we're at, for instance, now. So right now we're starting to look at June numbers for the banks, and that's going to include this COVID-19 era time frame, the 3 months. And we're trying to figure out with the banks, depending on the type of deal, whether it's retail or work in process or manufacturing, shipping, how the bank is going to want to handle those transactions.
So you sort of mentioned the COVID-19 stuff. So how has this pandemic impacted the availability and quality of audits, if at all?
Well, it's had a significant impact. We had a very hard time. March and April wasn't too difficult because most of that stuff was already in the pipeline for us to begin with. End of April, May, and beginning of June was really difficult to get borrowers to cooperate with us, to let us in. Well, we went to a remote model in early March to give us access to the books and records. We used to say to let us in, but we're actually not going in. We just started going in last week on a more regular basis, actually visiting the borrowers. So it's definitely impacted the availability of getting exams done. They're taking a lot longer to get done. A field exam that may have taken 2 weeks to turn around before is taking 3 to 4 weeks now to turn it around. So in some instances, the information by the time we get done is not even as relevant as what it used to be. Inventory test counts, our firm took a stance that we weren't going to do them virtually. So some of our competitors were doing them, which was fine, but we decided not to do them virtually. So we've delayed a lot of our test counts for the banks till about now. So in July, we're spending a lot of time going around and actually doing the test counts or observing a physical inventory and reporting back to the bank.
How are you accomplishing it remotely?
The field exam, it's very difficult. We already had a good data room model set up. We did about 20% of our business remote before COVID-19. So switching over wasn't a big deal for us and our staff. The borrowers, it's a big deal. Think about them having access to information that's sitting at the office, invoices, shipping documents, maybe something like a purchase order that they didn't get a chance to put up on their archive or whatever. And we don't have access to that. The company's not allowed to go and get that information and send it to us. So most of our reports now have some open item that either has to be followed up with the next field exam or at a later date when the company can accommodate. So the borrowers are having a lot of opportunities to say why they can't access certain information that, before February of 2020 was easily accessible.
How has that been impacting your clients?
The banks have been very accommodating right now, and they've been very patient, but the quality of the information that we're providing to them is not the same quality that it was before March 1st, 2020. And we all recognize that. And that is a concern that we have and our customers have. Many of our customers are internal departments within a bank, and they are challenged and tasked with putting out a quality field exam for their loan groups. And all of us in that group are very concerned that the quality of the information that we're ultimately giving, the completeness may not be there. And as a result, we may have to do more field exams in the future once we can get back on site or have access to information more readily. or follow up with these open items.
In your audits, are you seeing evidence of fraudulent behavior by borrowers?
Well, there's definitely strange behavior and things that we've noticed. Some pre-billings that we had to notice with borrowers in the past. Some of these field exams we do on a regular basis, maybe every 4 months or twice a year, once a year annually. And a couple of companies, we noticed some pre-billing activity that we had not noticed in the past. And in discussing that with the company, it was interesting. One particular case was a pretty significant amount of money that was pre-billed. And in some instances, the inventory was never shipped because of the timing of when we were out there and the pre-billing and the nature of it. So they had to have that discussion with the bank and determine, that's a different level, and they've worked it out. We had another instance where the company took a big chunk of their AP and developed note payables and buried them deep in the trial balance. And when we asked for the documentation with the vendor, there wasn't any. So essentially, they just removed a big chunk of AP to make it look a little bit better, and the bank wasn't happy about that either.
I'll bet. So you sort of touched upon it a little bit, but what exactly can be done remotely for audits and what can't be done remotely?
So right now, the one thing that we're saying can't be done are the physical inventory test counts, or the physical observation of the inventory. That's one area that we're choosing not to do remotely. It's just not something that we feel comfortable with. Many of our test counts can take 8 hours in the warehouse, 4 to 8, 6 hours in the warehouse, where we're working closely with staff. And that gives us a chance to ask some very good questions that we're not going to necessarily get by doing it remotely. So that's just a risk that we've chosen not to take. Everything else we've pretty much managed to do remotely. It's just taking a lot longer. It's more difficult to get answers. There's a lot more delays. And then obviously the face-to-face discussions where you're sitting across the conference room table with the CFO and you're asking very difficult questions that he has to answer right then and show documentation for, that's not happening. Even with Zoom. I mean, we've been on many calls where we've gotten into some difficult conversations with the company and they've said, oh, we have to go for a minute. How about if we resume in a half hour? And it really disrupts the flow of information and us getting to the bottom of a particular issue. And of course, like I said, the lenders are being very accommodating, so we're not able to push as hard as we used to be able to.
Well, what sort of risks are being created by the bank's current accommodative stance toward borrowers, if any?
I mean, my attitude is a lot of risk. I think that borrowers have recognized for years that they kind of sit in the steering wheel right now. They're driving the process when it comes to a field exam. They, tell us when we can and cannot come, and it's become even more so now with providing information remotely. They give us information as they deem it necessary for us to have, and we think there's a lot of risk with that. We actually we had one example where the shipping documents were manufactured to support the shipment, the date of the shipment. The inventory was shipped, but the shipping dates were absolutely not correct. And we verified that by actually getting tracking numbers and going to FedEx, UPS, so on and so forth. So, but at least it bought the company about a week and a half of time to negotiate with the bank as we sat there and tried to figure out what happened. So we think there's a lot of risk.
So what are the warning signs that should make a bank consider doing an audit like this? And is it different now than it was previously?
I don't know that it's much different, except that it's going to be, the banks are looking at the borrowing base certificates very closely as they start to come in now, including May and June's activity, and seeing that cash was collected. Maybe the loans weren't paid down, maybe they were paid down and not enough. What's still not being collected. So those are the analysis that the banks are doing internally. And then they're giving us that feedback. And I think the biggest problem we're going to have as an industry is going to be, we've gotten very busy right now, and banks are calling up saying, we need to know right now. They're getting the June borrowing base certificates and saying, we need to know right now what's going on out there. And that's probably not going to happen. We're getting back up to our backlog of 4 to 6 weeks, and banks, I think, are going to be a little bit more insistent that right now means next week, not 4 weeks from now.
So you would recommend the bank contacting you immediately if they think they have an audit need?
Well, I mean, I would recommend that. I've been sending out emails to our customers that they're getting audits on the docket before they think they need them, because we can always reschedule or plug something else in, and not to wait until the company's ready necessarily, not to wait until they get the borrowing base certificate, but to plan ahead of time so that we have that slot for them to be able to accommodate. Some banks have done that, and some ABL lenders have been unwilling to do that necessarily, and it is creating a little bit of a problem. Just got an email today that I'm not entirely sure that we'll be able to accommodate, just because it's too much of a last minute notice. And given where we're at, I'm not sure that we can cancel other field exams to accommodate those.
Yeah. Thank you, Robert.
You're welcome.
Tim?
Yes. Hello.
You're on the valuation side of inventory, correct?
Correct. Absolutely.
Okay. What sort of trends have you been seeing in valuation?
So in terms of just very broadly for valuation, I think the big trend is the cadence of the updates of the valuations. Things historically that we might have been appraising one time a year, we're now doing twice a year. Things that we had historically being done 2 times a year, we're now doing 3 or 4 times a year. I have several clients as we speak that we're basically, revaluing them monthly at this point. So a very quick cadence. And it basically all comes down to, where the company is in terms of financial health and where the bank is in terms of, their risk tolerance. But, we have the ability to kind of monitor that for them as quickly as they want. And, very similar to what happened in 2008, 2009, that light switch gets flipped pretty quick and the cadence goes up. So we're very much in the thick of that right now.
What sort of risks are there to lenders with respect to inventory?
Yeah, it's a good question. I mean, historically, the proverbial risk has always been that, when the lender pulled the plug and wanted to go in and liquidate the inventory, that, as the company's financial health was sliding to raise cash, the company would sell off the good inventory. So then we would come in as valuators, or we would come in as liquidators and say, all the really good stuff, it's gone, and it's probably been gone for a few months. That's still very much true. I don't think that'll ever go out of fashion per se. But the other big thing I'm seeing, and I started seeing it in March and April and May and June, July, is that I'd say 9 out of 10 deals that cross my desk in any given week, the inventory balance itself is wrong. And by wrong, I mean it's either not seasonally appropriate. It might be goods that should have been sold in March that weren't, and now they're still on hand. And who wants spring, summer merchandise when we're heading into fall and winter? Or the more interesting part is that, the good inventory might still be there, but they might just have way too much of it because their customers didn't take it. They had orders canceled on them. I mean, there's 15 different reasons, but very generally just the inventory profile that we are seeing in a lot of companies is just not what it should be. And that's been a big challenge.
Yeah. I think in your specialty is consumer product inventory, right?
Consumer product through to retailers, correct?
Right. So what are the realistic recovery rates for the different types of inventory, starting with consumer product inventory? And if you could also elaborate on whether or not that has changed in the current environment.
Yeah. So, I mean, there's a general spectrum that looks like a sideways pyramid. And, historically and today, and I'll get to the today part later, but historically the best value, from a disposition point is always going to be, doing a going out of business sale at a retailer where, you're putting up the proverbial sign on the outside, you've got the sign walkers, you've got the customers coming through the front door, you're selling at a margin. It's a pretty finite, universe of, kind of valuation model there. I would say very broadly values within liquidating retailers would be 80, 90 cents of cost all the way over to 100+% of cost. So very strong historically. And then,
you, Tim, but is that currently, or is that
no, currently the other half of that story is currently no. I mean, and broadly speaking there, what we're seeing of things that we've done in the past, call on a pre-COVID basis, that we're updating now to COVID world, call it 10 to 15 percentage points lower than what it was. And it's a very dynamic situation, obviously, because you have a big country and you have COVID hotspots and you have hotspots that are moving around, and you've got areas where stores are open and areas where stores aren't open, and just a flood of different variables that we've never had before. But 10 to 15 is where they're coming out today. And, you know, that changes almost on a weekly basis these days in terms of, you know, what's going on in Florida versus what's going on in the Northeast, what stores are open, what stores are closed, et cetera. And then that spectrum then moves into consumer products, and, you know, consumer products are, you know, very broad, but ranges of value can be anywhere from, call it 40 to 70 cents pre-COVID basis net. And there, you know, we're seeing deteriorations as well, but not as bad as when you have stores that are closed on the retail side that you can't physically use. But, you know, I'm not surprised when I see 5 to 10 point reductions on the consumer side these days. But it's all very, very specific to industry and very, very specific to the types of inventory. You know, there are a lot of folks that are obviously not performing well, but there are strong pockets of inventory and strong pockets within different industries where they've held up pretty well.
And what about industrial inventory? I know it's not your specialty, but I know you have some knowledge there with respect to like raw materials and finished goods.
Yeah, that's gonna trend pretty close to where consumer is. If you say 40 to 70 on a consumer deal is broadly where things shake out. That's going to be in the same range. The big variable with industrial always is work in process and raw materials, and there it's going to come down to, you know, what it is. If it's a raw material that's a commodity, call it paper, lumber, metals, things of that nature, it's going to recover well. It's going to be within that range, if not better. But, you know, within industrial, you've always got those three pieces of inventory. Then that mix is going to blend it a little bit. And we're seeing that same pre-COVID, post-COVID type mix in terms of, you know, 5 to 10 point reductions is not surprising these days based on what
and I think when we spoke previously, you had told me that with respect to the consumer product inventory, that there's just such a large amount of it that has a lot to do with the values decreasing.
And that's the second big trend if you want to talk about major trends of things. So going back to what I was saying earlier in terms of inventory balances being out of whack and it might be seasonally inappropriate, the challenge for those.
I can't hear you, I'm sorry, or at least I can't.
Can you hear me now?
Yes.
Okay. So the big challenge is when you have the seasonally inappropriate inventory mix is what do you do with that? And a lot of those companies are saying, I missed the spring selling season. I've got $10 million of stuff. Should I pack it away in the warehouse or should I sell it? And a lot of those goods are winding up on the open market in terms of the Brands for Less channel, the proverbial bottom feeder liquidator channel. There's just a flood of goods because of the crater of March, April, June, you know, when COVID hit, that are just out there in the market right now. So when we look at appraisal values, we have to factor in, you know, supply and demand generally of what's already out there in the market and what would we be competing with if we had to liquidate that chunk of inventory. So there's a huge pressure right now on those values because of that.
So with all that said, how much should lenders be advancing relying on inventory values?
Well, we're giving very accurate up to the minute valuation. The piece I always say to that is that in the past where we might have had an appraisal that had an inherent shelf life of 6 months or 12 months, given what has already happened so quickly and given how things are still changing so quickly, that value that we're going to give you today, which is very accurate, probably don't wait 6 months and definitely don't wait 12 months to get it updated. Either you know, fully engage us again in 3 months, or the very easy thing is, you know, pick up the phone and give us a call and say, you provided me a valuation last month as of, you know, whatever date it was. It's now been 4 weeks, 6 weeks. Tell me a little bit about what's going on with the company. And I can give you a little bit of feel of, you know, that's probably still a good number, or, you know, we really should get in there and do, you know, everything from start to finish again on a new engagement.
Are you having any issues with performing the valuations because of the pandemic, or are you typically
No.
looking at, you know, a list of what the items are? And
Yeah, my business is a little different than Robert's business in terms of field exam versus valuation. We don't, historically we would have gone out and we meet with the company face to face. We're now doing that via Zoom, like we're doing this. Historically, we would tour the warehouse just to understand the operations. We can do that now in a variety of different ways. So there really hasn't been anything that we can't do to put out a report, pre-COVID versus post-COVID basis, which has been nice.
yeah, that's great. So when is it a good idea for a lender to get an appraisal on inventory?
Well, definitely before the loan is made. We always say we want to, set the base and put it into Robert's borrowing base certificate, and then go from there. But from there, it's going to come down to company performance. And I always tell folks the big things that drive the valuation. My valuation is sales, inventory balances, and gross margins. And once we set the baseline of those variables, if the lender starts seeing big changes in any of those, it's a good time to at least pick up the phone and say, can we talk through this? And that's always a free dialogue. And from there, if we think there's any reason to be concerned, then we'll move into an engagement.
Are there any risks associated with the borrower having control of the inventory?
Of the inventory appraisal, the product?
Yes.
I would say a good 15% of my business is when we're engaged directly by the borrower, by the company. And to me, it makes no difference. It's the same product we give to them that if we were engaged by a lender directly. Typically, the only difference there is that, the borrower is going to take that report and give it to 6 different lenders. And then I'm going to have, individual calls with 6 different lenders, and that's perfectly fine. So there's no difference in the product. There's no difference in the process. It's just, company's prerogative if they want to engage us directly.
Great. Thank you, Tim.
Sure.
Andy, I'm going to ask you the $1 million question that everyone's sort of getting today, and that is, first, you specialize in appraising machinery and equipment and also liquidating it, correct?
Correct.
Okay. So what sort of recent trends are you seeing in equipment valuation, and what are the in expected trends? I think when we spoke previously, you had told me about some expectations of where the trends are going to be going that were very interesting.
Well, I think from our perspective, we're still early in this crisis. In terms of trends that we're seeing, it's proving out that this is a very unusual situation, unlike any other of the previous downturns. We fully expected during the shutdown in March, April, May, when auctions and liquidations were postponed, companies are capital constrained, lenders are not lending, that the sales market, which is the basis of our valuations, we're market-based appraisers. We provide, our analytics are based on market comparables. We fully expected once the engine of sales, used equipment sales, started up again, which happened in early May and through June. And in fact, Hilco's run 4 or 5 sales in the last 8 weeks. We fully expected a big drop in value. We're seeing we're happy to say that in many instances, we're seeing fairly strong recoveries, stronger than we would have expected. Now, that's not to say that things won't get worse. My expectations is, it's a supply and demand issue. There will be an oversupply in many industries, but it's in an industry by industry situation. In the oil field services space, that's a huge problem. There was already an oversupply. There will continue to be, and you're going to see big depressed values there. In the automotive industry, plastics and metalworking equipment are being affected, mostly in the large tonnage, high spec asset types. We're starting to see things like OEMs, the original equipment manufacturers of these assets, not the automotive OEMs, but the equipment manufacturers, starting to offer deep discounts. That's going to start to affect used equipment prices. So all of those things are still coming down the pike. Now, that's not unusual. Equipment usually takes several quarters to be affected by a situation. In this case, there was a dramatic freeze up of the markets, and when things loosened up, it turns out there were some buyers. I think my opinion is they're opportunistic buyers. They're not our usual buyers. Normally, you would have a company buying a used equipment dealer, perhaps buying end users, et cetera. I think this is a more opportunistic situation that may turn into a more depressed situation.
So are the trends in value, are they differing based on the age of the equipment and machinery?
Well, one of the biggest trends we're seeing through this right now is that the ratio between age and value is shifting pretty dramatically. If you had assets that had a value that were 10 to 15 years old in a report done in December, those assets may not have anything but a scrap value today, just because the buyers are interested, the buyers that exist are interested in late model, high spec quality equipment. So the older assets that you used to be able to easily sell through a liquidation or appraisal or evaluate an auction process, they may not sell in the current market, and we're starting to see signs of that. You have many metalworking manufacturers, equipment manufacturers that are offering 30-40% discounts on new assets. So if you're a buyer and you're going to a liquidation, you need to do a calculation. Do I pay 30% for something that's 8 years old and I don't get a warranty, or do I pay 60% for something that has a 5-year warranty and will last another 20 years? So those are the calculations, one of many that are affecting our work as both an evaluator and a liquidator.
When should a bank consider getting an updated valuation?
Well, certainly, as Tim said at the start of the loan, you'll get one post bankruptcy, I imagine. But in terms of updating an appraisal, it's often constrained by covenants and the terms of the loan. But as those start to expire, there's some industries that you may be looking at quarterly appraisals. In the oil field services space, we're doing quarterly appraisals. In the automotive space, if you have an automotive stamper, say, or automotive plastic injection molding company, you may go from a 1-year update to a situation where you're doing a desktop appraisal on a 6-month basis with an on-site on a yearly basis. But it's really industry by industry.
Are there any risks associated with the borrower having control of the equipment and machinery that you've seen?
From an evaluation perspective, as Tim said, we're agnostic who the client is. We're going to do the same quality work regardless, and we'll be an advocate for the report who ultimately uses it. Ultimately, it's always ends up for the lender. 10 years ago, 100% of our appraisals were engaged through institutions. On the equipment side, probably 50% of our engagements are now direct to companies because they've gotten smart and they want to go out to market with a field exam, an appraisal, a whole package that they can give to 7-8 banks and get the best deal that they think they can get. But we're going to do the same work regardless.
What does a lender need to give you to update the valuation?
From equipment perspective, we're focused, and this was affected. During shutdown for the first 8 weeks, we weren't able to travel, and travel situations right now with COVID flaring up in parts of the country, quarantines requirements in certain parts, access to companies' records are being affected, making our job difficult. And that's because we need to see the assets at least the first time we do the appraisal. So that means looking at the assets, checking condition, gathering, the information that are keys to value, like make, model, year, and specifications. So that's key, access to the plants. Now, we can do an appraisal if that information is provided. What the client should understand, much like Robert's business, things that used to take 3 weeks are taking 4 or 5 weeks, because when you're asking a company to assist in the gathering of that information that your experienced team can gather in a matter of 4 hours, it takes them days and weeks to gather. It throws a wrench in the time frame of everything. But if I had one message for the financial community, and Robert's touched on this, Tim's touched on this, is we're all drinking from a fire hose, and talk to us sooner in the process, as soon as possible. That doesn't mean spend money on us. It means get us engaged in the process, and we can usually help you out better if that's the case. Calling us in the third hour, it's problematic because we all have full pipelines, and it's only going to get fuller.
So when contemplating doing an appraisal or evaluation, what is the biggest mistake a lender can make? And I sort of assume it may be what you just said, waiting too long, but I mean, I'll let you.
Waiting too long to get an update on an existing appraisal. The machinery equipment appraisals are probably updated the least frequent in terms of any of our asset classes. Tim does retail appraisals on a monthly basis in some cases. Most M&E appraisals are updated every other year. In bigger deals, perhaps annually. But when you go through a downturn like this, the first thing that affects the collateral on the equipment side is that companies are suddenly desperate for cash, or they don't have any cash. And so the first thing they're going to do in terms of equipment is cut CapEx spend on maintenance. So what that means is they start to take parts and pieces off of existing assets to make the assets they need to run. So that degrades the values of both those assets. Sometimes companies try to sell assets to get some cash flow. When you suddenly sell certain segments of the asset pool, it could affect the whole pool. Because if a company sells 2 or 3 of the nicer pieces in a plant, it makes the ability for a liquidator like Hilco or any of the other big players to draw an audience for the other assets, which you need. So there's a lot of things that can really hurt value if you ignore a file. A lot of lenders are taking the stance that they know it's bad, they just don't want to know how bad. It's
willful blindness, just the worst.
Yeah.
No
offense, lenders. We love you.
Well, thank you so much, Andy. And so the last person that I'm going to talk with is Andy, certainly not least. So again, the $1 million question for you as well. What are the recent trends in valuation? And you specialize in real property, right?
Correct. Yeah, our firm, Friedman Real Estate, specializes in physical assets, real estate per se, of all major asset classes. But yeah, the recent trends are quite interesting in the real estate sector, and I think it's very industry specific in real estate, whether you have a retail asset, office, industrial, or multifamily, kind of the 4 main food groups. I'd say that the trends are wild in every different direction. For example, retail and hospitality assets right now have seen large decreases in valuation. Many of the tenants that occupy and pay rent on the retail assets aren't paying, are going out of business, probably very busy with Tim and his retail liquidation segments. But yeah, a lot of the tenants aren't paying, so it's having a big impact on property valuations and cash flow. Conversely, on the industrial side, we're seeing an extreme, hold of valuations on that sector, and actually an increase in valuations. Industrial demand, given the large presence of e-commerce and excess distribution and warehousing space that companies are looking for, is actually leading to an increase in valuations on the industrial side. We're seeing very strong demand in that segment. And then, office and multifamily kind of falls somewhere in between that. Once again, very depending on the credit. Some higher credit, higher quality tenants on the office side continue to pay rent, continue to maintain those cash flow positive metrics we're seeing. Conversely, if you have lower quality tenants, maybe retail tenants in your office building, hospitality tenants, or in the multifamily side, if you're in a area with a largely been affected by tourism, travel, hospitality, a lower demographic, you're starting to see some deteriorations in valuation. So it's very industry specific, and I think you have to understand your collateral and your local market quite a lot on the real estate side, because the valuations are changing quite a bit as we're seeing changes in states, in local markets, in industries about who has credit and who does not.
Wow. So what does a lender need to do to preserve the value of its collateral once it gets control of it?
Yeah, and I think that lenders in this environment really need to take a more proactive approach, very similar to what the other panelists have said, to really understand what collateral they have. Rent collections are the #1 metric that we're watching on all real estate assets across the board right now. And if you don't have a good handle of your rent collections and what tenants are paying, it can lead to an asset value deterioration quite quickly. And so, upon a foreclosure, the first thing I always recommend is when you get a receiver and process, your foreclosure, make sure you have a real estate mind as well too in process that receiver. If the receiver is going to engage a property management or brokerage company, make sure you have someone in there understanding the industry-wide trends. And the reason I say that is right now our firm is cutting a lot of real-time transactions with tenants. Understanding blend and extends, looking at their leases, understanding and cutting deals on them paying rent. There's a lot of movement right now in that industry to understand, what type of deals can be cut with tenants to make sure they can stay there for the long term, because you don't want to replace a tenant right now in a lot of sense because demand is low unless you're in that industrial sector. I think the other thing as well too, make sure you get someone in there on the physical side of real estate as well too who can help manage the property. In the summer months right now, for the most part, your buildings will hold up in pretty decent shape. But if you take too long and don't prep your buildings for the winter, make sure that your maintenance is on check. Those buildings and building systems can deteriorate pretty quickly. We see that a lot with absentee lenders and absentee owners where, you foreclose an asset, borrower goes away, bank takes a while to put in a proper, receiver or management company. Those building systems and buildings can get, pretty deteriorated quickly. So be proactive, make sure you have a real estate mind as well too, in that process, because I think the real estate industry is probably drastically changing and affecting a lot of trends quicker than we thought, especially on the retail and industrial sides. So making sure that you're aware of the trends going on is gonna help you save value, or maintain it a lot better.
Oh. So what are the merits in getting a broker assessment of value versus waiting longer for an appraisal? Is there a difference?
Yeah, so our industry has a lot, two differences in the appraisals or broker opinion of value. Appraisers are licensed and they do a more detailed process. You'll see anywhere from a 6 to 8 week process to get an appraisal. Our firm does what's called broker opinion of values. Many of our competitors and the larger players in the space do it as well too. Essentially, it's real-time preliminary feedback on what we're seeing in the market from a demand and supply standpoint. And so generally, we can turn around broker opinion of values in 5 to 10 days, sometimes even less, depending on the amount of data that we have. and give you real-time sense of where real estate values are trading, what potential tenants would be interested in your space, and what supply looks like. And so we can turn around those broker opinion of values very quickly. It takes a combination of cash flow metrics in place, understanding your rent roll, your rent collections, understanding how your borrower should efficiently or the lender should efficiently run those buildings from an operating expense standpoint. And then also too, understanding what's going on in the market from a comparable standpoint. Assets are selling on the real estate side, probably better than I thought they would. I thought that there was going to be a pretty big freeze in terms of trading of real estate values and assets here, but surprisingly, we are moving real estate assets. So giving you a real-time information about where pricing is and what it should look like for your specific asset. Once again, depends a lot on industry, but we're seeing assets trade anywhere from par, where we thought valuations were 6 months ago, to 50% discounts, for some retail and hospitality assets. So understanding the investor demand real time is important in that BOVs.
Yeah, I mean, it sounds like the broker opinion would be really valuable. I mean, is there any benefit to having an an appraisal?
Yeah, I mean, appraisals, I think are, all lenders require appraisals, and I think they are very detailed and very good. I would just say that the broker opinion of values, we have a very fragmented and inefficient market on the real estate side. Most things are traded, not on exchanges, through brokers, kind of in a series of off-market transactions or on-market transactions, but there's no real database. So I think understanding the local broker or regional player who can understand who your buyers and sellers are is important. Obviously appraisals have their place in the industry for sure. They provide a lot of detail in terms of what groups are seeing, but we think our broker opinion of values can give you a real sense of what assets can trade at real time.
That's great. Does the lender need to give you anything to update the value of the collateral?
Yeah, generally there's 4 big pieces of information that we would like. Number one, an in-place rent roll, understanding what your tenancy and your term of your leases look like. 2, any historical expense statements. I mean, we can have a pretty accurate idea of how these buildings should be run, but any real-time specific property expense information. Number 3 is building CapEx. Any old property condition reports, real-time CapEx that's been spent at the property. Those numbers from a roof to a parking lot can get pretty expensive, so understanding that's important. And the number 4 item, which we've recently added to the list, is rent collections. Those are probably the most important metric in understanding what your real estate assets are worth. Like I said previously, a lot of tenants in the retail space aren't paying rent. We've seen anywhere from 30 to 50% of tenants on the retail side, not pay rent, which is an extremely large effect on asset valuations. And even some of the major companies too that have some pretty strong credit are using their power in terms of the size of their company and the entities they run to not pay rent as well too. A lot of them on the edge of bankruptcy. So rent collections is extremely important. And I think too, looking at that pretty proactively is going to be important, especially in the multifamily space, as the PPP or the $600 a week that the Fed is providing for the unemployment, comes to run out here pretty soon. That'll be pretty interesting how that has an impact on rent collections. And then as the PPP money runs out for a lot of these companies as well too, who were able to use that portion of rent, running out of that cash flow will be interesting as well. So rent collections is probably the biggest and newest item that we've added to our request for lenders to understand, what's going on with their assets.
So in your opinion, what is a realistic timeline to liquidate commercial or industrial real property?
Yeah, so, from a standpoint of, I'd say 45 to 90 days is probably a more realistic sense. One thing that we've been really busy with, we were really busy with in the 09, 10, 11, 12 downturn, and starting to get busy with as well too is real estate auctions. Our firm specializes in trading real estate assets on auction, which provide essentially a 45-day, 60-day liquidation of real estate assets. And so if you're looking for certainty of execution and you're looking for timely execution, we can sell those assets pretty quickly. And if you're really looking for, a speedy time frame to recovery, selling the note is potentially a really interesting avenue as well too for real estate lenders. The note sale industry has been really interesting. We've seen a lot of opportunistic buyers of notes come into the space who've historically been there, but also have added, some capital to that space as well too, chasing opportunities. So we've seen note recoveries trade anywhere from 80 to 95 cents on the dollar in a lot of instances, and that time frame can actually be really short. I say there's maybe a 30-day process to sell the note, which provides a pretty decent recovery for lenders, gets the note off their balance sheet, makes it someone else's problem. But there's a lot of interested and opportunistic buyers in that space thinking that they're, buying a loan at 10, 15 cents less than par, is an interesting opportunity for them. So there's various different ways you can liquidate real estate, whether note or, fee simple interest form, but 30 to 90 days probably is a realistic time frame. And depending on how much recovery, we can either speed that up or slow that down to find and identify the right buyer.
It's really interesting. I think, is environmental due diligence important in any of this?
Environmental due diligence really depends on the way you sell it and the, specific industry. For multifamily assets, people have a less importance on the environmental. They normally look at historical information that was provided. Reason being is a lot of buyers of real estate don't expect that any true environmental issues will happen, at a multifamily asset. But on industrial assets, it's extremely important, especially when companies are in the automotive business, oil and gas business, manufacturing business. It does make a big impact. A lot of buyers are getting aggressive though and stepping up and kind of waiving that long lead time for environmental. That could take anywhere from 4 to 8 weeks a lot of times, especially with the long lead times we're seeing now. So I think environmental just depends on the specific asset. Also too, different states have different laws containing environmental. I'm based in, a lot of us are based in Michigan. We have a pretty lenient, situation when it comes to environmental, where a lot of future buyers aren't necessarily liable for past instances. So as long as they file the right government documents. So I think state matters, and industry class asset matters too. But, for the right asset, we can get buyers comfortable with previous environmental concerns as well.
Great, thank you so much, Jared. We do have a few questions that were posed by attendees. I was informed that for whatever reason, the chat is locked. So if you do have a question, there's a little box blurb at the bottom of your screen that says Q&A. If you put your question in there, some people figured it out. If you put your question in there, we'll be able to see it. So, it's my understanding we have a question for Tim. What is the timeline to get an appraisal or update? I think
I'm sorry, say again.
What is the timeline to get an appraisal or an update?
We're about 3 to 4 weeks timing, and that's start to finish. If you come to us and say you need it a little faster, we can do it a little faster, but we're about 3 to 4 weeks generally and right now.
Awesome. And then there was another question for you, Tim. Are borrowers cooperating with banks when they order an appraisal update, or are they resisting access?
Very generally, they are absolutely cooperating. The one thing that is occurring, and I don't think it's anybody's fault, is that a lot of folks are working from home and might not have access to everything they had in the office. So in terms of providing us the financial data we need, sometimes it takes a little longer, but it's not that they're not cooperating. It's just, such is life these days for all of us.
And this is a general question for everyone. Does anyone have any input on COVID supply chain matters affecting equipment / system values? Anyone? Andy? No one. Okay. Andy, when is it a desktop appraisal okay versus a full appraisal?
Generally, a desktop should be an update of a previous appraisal. Now, in some cases, for commodity type assets like transportation equipment, Class 8 trucks, construction equipment, where there are, hundreds of thousands of data points that we could point to. If we get really good data, we can perform a desktop as a first appraisal. It's not our preference. Generally appraisers are more conservative when they haven't seen the assets or where they're doing just a desktop appraisal. So there's usually more upside for all parties if the first appraisal at the very least is a site inspection where you can talk to the company, get an understanding of their maintenance, etc. But preferably it's desktops are for updates on the equipment anyway.
Thank you, Andy. I have a question for Robert. How are banks responding to collateral shortfalls of AR and inventory found in audits?
Well, so right now, that's all just starting to come out as they're submitting their May and June borrowing base certificates. There's a lot of discussion while we're quote unquote in the field or doing the field exam with the borrowers. We're doing more analysis. We're actually looking at more invoices, doing email and phone verifications more regularly to confirm that. And then the banks are deciding whether or not they want to give exceptions to extend the borrowing period on the AR or to be a little bit more lenient on the inventory. As was mentioned earlier, they may have more inventory than they should. They may be above their caps. There could be excess inventory per our calculations. And I think banks are a little hesitant to throw in any big reserves right now. And so there's just a lot of discussion about that. They're being patient.
Great, thank you so much. Just checking to see if we have any other questions. No, I think I got to all of them. If anyone has a question, type it quickly, because I think we're going to wrap up. I wish that this could be more interactive, like real life, but unfortunately, the current state of the world doesn't allow that. But let me just make sure. Yeah. Well, anyway, thank you all for attending. I hope that you obtained some information that you didn't know. Personally, when I spoke to these gentlemen, I found the recent trends very interesting, and how the pandemic is affecting their business and what they do, and how it's impacting lenders generally. So in any event, thank you all for joining us, and have a great day. Thank you.
Thank you.
Thank you, everybody.